Hello and welcome everyone to our latest webinar. My name is Sid Rajeev. I'm the head of research at Fundamental Research Corp. Our guest today is Desmond O'Kell, a senior VP and director of Enterprise Group. Shares of Enterprise are trading on the TSX under the ticker symbol E. Enterprise is profitable. It is on a list of top picks, and we estimate that shares are trading at just 3.5 times revenue EBITDA, which is roughly 50% lower than the sector average. Now, Enterprise undervalued valuation metrics and our bullish outlook on oil field services companies is why we invited Des to join us today. So thank you so much, Des, for taking the time.
Well, thank you for having us, for sure.
So the agenda for today is I'll kick off the call with why we're bullish on the sector, and Des will take over from there and introduce us to his story and growth plans. Listeners, you can wait till the end to ask questions, or if you have questions during the presentation, you can submit your questions and we'll respond at the end. So here are some key disclaimers. Please take a moment. All right, so let's get started with a quick look at oil and gas prices. Prices of both oil and gases are down significantly in the past year, but from these charts, we can see that oil prices are still well above their 5-year average, and gas prices are in line with their 5-year average. The primary reason for lower prices is explained by this chart showing slower global GDP growth. As you can see, GDP growth is expected to decline in all of the major regions worldwide, driven by inflation and a high interest rate environment. Now, that said, the near-term outlook and long-term outlook for both oil and gas remains robust. We have consolidated the price forecasts of major oil and gas price forecasters, and as you can see, forecast prices are well above the historic averages. Now, oil and gas companies prepare CAPEX budgets based on their price forecast. So if they're expecting prices to increase, they will raise their CAPEX budgets. That's what we are seeing today. Several oil and gas majors have announced higher CAPEX budgets. For example, Chevron has announced a 25% increase in spending this year. Globally, oil and gas CAPEX spending is expected to increase by 12% this year. Now, in this slide, we can see that all of the major sectors within the oil and gas market have higher CAPEX budgets this year. Bottom line, we believe higher CAPEX budgets should directly benefit oil field services companies such as Enterprise. Now, let's take a quick look at valuations in the space. This chart here shows the enterprise value, or EV to revenue and EV to EBITDA of oil and gas service providers. Both multiples are at their lowest currently in the past 5 years. However, as we discussed earlier, oil prices are higher than their 5-year averages, and CAPEX spending is also higher than their 5-year average. So clearly, valuation metrics should also be higher, or at least flat, but definitely not lower as we are seeing in today's markets. This is the number one reason why we're bullish on the sector today. And before I invite Des, let's take a quick look at where Enterprise stands. I took this table from our most recent report on Enterprise. So if you have not seen it, make sure you check out our platform, researchfrc.com. Under company search tab, search for Enterprise Group, and you can see all of our previous reports and notes on the company. So as per our last report, you can see that shares are trading at just 3.5 times forward EBITDA versus the sector average of 6.6 times. That's almost a 50% discount versus comparables. With that, let's welcome Des of Enterprise Group. Des, you'll be able to share your screen in a second.
Yeah, sure will. Thank you. Here, let me just...
Please go ahead when you're ready, Des.
Yeah. Okay, folks, this will be the start of the presentation here. The numbers that we'll show you here will be reflected from our most recent quarter end. And I'd like to start with the just simple disclaimers, just like Sid had on his deck. This gives you what I really want to start with is what do we do for our clients? What we do is we bring all the site infrastructure to drilling, completions, plant builds, and so forth. What we do is we don't have any drilling or fracking equipment. What we bring is the site infrastructure. So basically the mobile office structures the medic buildings, things like the bathrooms, the lighting, the heating, scaffolding, all of the materials that you need to operate on site. One of the most important elements that we bring to these sites is the mobile power systems. And we're going to talk a little bit about some of our leading changes and innovations that we've done over the past 3.5 years with our mobile power systems that we're bringing onto site that basically powers the entire site, as well as some of the equipment as well as our site infrastructure. So you can see the areas that we're working in. We're in the Western Canadian Basin. We're predominantly operating in that foothills range. I'll show you a map a little later. Our equipment and property assets are appraised at well over 50 million, which includes that fleet of low emission power systems that we're going to talk about, well site modular and combo equipment, specialized heating, and other site infrastructure. What we've done over the last, I just want to make note that we've been around for almost 20 years. I think we're in our 18th year. As you can see here, we're incorporated in 2004. We were public in 2005. We graduated.
I want to interrupt you more. Sorry for that. I think we are seeing a last slide now. Maybe you want to.
Oh, what's going on here? What do you see now?
Yeah, no, perfect. Yeah, go ahead. Sorry.
Okay. So this shows we're incorporated in 2004, public in 2005, graduating to the TSX in 2007. Just at the beginning of this year, we acquired our OTC QB listing in the US. We have, like I said, we've been around for 18 years. We've gone through some very, very tough times. We had a 7-year downturn that started in late 2014 that we just came out of in 2021. We've been obviously with our new innovations, we're assisting our clients with their ESG goals through our power systems, which are basically a transition from diesel to natural gas that we'll get in here shortly. Of course, the new avenues of growth regarding our natural gas for electricity and microgrids. We see this adoption certainly in the energy sector has been terrific to date, and we do expect to explore other industries with this natural gas, electricity, microgrids. It's important to note that management are big owners of the company. We now have over 40% of the outstanding shares. We have a fairly aggressive NCIB program, normal course issuer bid. It renews next month, and we plan, of course, on renewing that. Since the program's inception, we've accumulated and canceled about 11 million shares. Okay, so this gives you a little bit of a financial snapshot. In the last year, we've been as low as 35, as high as 48. I think today we were 41, 42 cents. We've got 49.7 million shares outstanding, gives you a market cap of around 21 million. The current EV is around 32.4. What's really important to note is that our total net equity is 37.5 million, which gives us a net book value of 75 cents a share. So as you can see, we are in a deep discount opportunity at the moment. These are the 4 subsidiaries that we operate. I'll spend a little bit of time on the 4. Evolution Power Projects. This is the company that we've been operating the new innovations for power systems. They are growing at a fairly good rate, and of course their primary technical and equipment assets are, of course, these mobile power systems that we're bringing that allows our customer to move from diesel fuel to natural gas. Let me explain. On a particular drilling or frac site, you're going to have these are 3 to 10 acre sites that may require a tremendous amount of lighting. So we have light towers that we're bringing onto site. So you might have anywhere from 6 to 12 light towers. Well, at the bottom of every light tower, there's a little diesel-fired generator that operates those lights. All of the office buildings and the bathrooms and the medic shacks and all these other buildings that require power that we bring out to site also require diesel power on site. So we're looking at anywhere from 10 to 20 diesel powered generators on site. So you got a noise issue on site with this many units. You also are consuming anywhere from 3,000 to 5,000 liters of diesel every day. And of course, diesel has a certain amount of emissions. And what we have done is, instead of bringing all of those diesel-fired generators to site, what we're doing is we're bringing one large natural gas-powered turbine generator onto site. So we lose that tremendous amount of sound on site. And what we're in most cases, probably 80% of the time, we are utilizing the client's natural gas that's produced on site or nearby. So what that does is our clients are now completely eliminating that purchase of 3,000 to 5,000 liters of diesel fuel a day from the fuel distributor that's bringing it out to these remote areas. Now, further than that, what it gives us is, of course, an incredible reduction in emissions. When you move from diesel to natural gas, you're getting a reduction of over 30% in CO2, and between 75 and 99% of things like SO2, NOx, and particulate matter. So we're bringing the ability for our clients. Many of our top tier clients are heavy emitters. So they are bound by new legislation in the last few years, where they not only have to track their emissions, they need to stay under a particular threshold. If they're under that threshold, they earn carbon credits, which show up on their balance sheet. If they're over that threshold, they have to pay monetary penalties. So these systems that we're bringing out to our clients, we are, at the moment, we have a first mover advantage. We're the only service provider in the industry that has moved to natural gas micro grid. So what we're doing is we're powering up the one unit, and we've got cabling and distribution panels happening around the site. So all of the lighting and all of the power needs are plugged into this mobile microgrid. So I hope that gives everybody a good explanation on our mobile power systems. Both Westar and Hart, as you see on your screen here, these are full service, full site infrastructure providers. Westar operates in northeastern BC, and Hart operates in Alberta. Arctic Therm is a very specialized, IP-rich heating business. We have some very, very interesting exclusive flameless heating units. We have a fleet of around 200 rental units, which are pull behind trailer style. They are around 500,000 to 1.2 million BTUs. And of course, we have a fleet of 10 large truck units that put out anywhere from 2.5 million to 3.3 million BTUs. Those were purpose built for the purpose of heating up pipeline steel at the construction phase. Not only that, we live in a very remote work areas in the north, and there's a tremendous amount of heating needed. And of course, these mobile massive power or heating units are used in all cases at plants. We're unthawing all sorts of equipment and refineries and stuff with these big, large units. So big demand, and of course, it's very, very unique, and our large trucks are one of a kind in the world. This gives you a bit of a animated look at what a drilling site would look like, and all of the equipment here. You can see those where we've got the light towers, and of course under that where we're indicating light towers, those would be the mobile office structures or wash cars, or what we call them, in washrooms and medic shacks. There usually is about 5 to 8 of those mobile structures on any given site. You can see that in the middle here, there's our natural gas turbine generators. And of course, you can see the cabling and the distribution panels that go around the outside perimeter of the site. So you can see that there's quite a bit of what we call site infrastructure that we bring to these sites. And I hope this gives a good indication illustratively. This is where we operate. Like I said, we're focused in this foothills region. So we have, of course, we have sales and administration offices in Edmonton and Calgary, but our branches are throughout central Alberta, all the way into the north and into northeastern BC. So many of our clients are gas and gas liquids producers. We do have an office for our heating business up in Fort McMurray, as you can see there. Fort McMurray uses a lot of our heat. So this gives you an idea of our footprint of where we're operating. So, just to add to what Sid has been talking about, why should we be looking at this sector, or in this case, enterprise? Well, like I said, we had a 7-year downturn where we were in very, very low activity levels between 2015 and 2021. So right now, for the last couple of years, our energy economy here in Canada is definitely back on. Many of the energy analysts, of course, are predicting higher oil and gas prices for an extended period. I think if we look at the situation globally, I think, hydrocarbon use is in demand is still growing. And of course, CAPEX over a long period of time has not kept up. There hasn't been any, magnificent new oil field finds around the world. So it's basically, it's been a capital-starved industry for quite a while now. And what's that's created is there's shortages of equipment now, and manpower, and of course expertise. And what that's done is it's allowed us to increase our prices over the last, certainly couple of years. That 7-year downturn that we experienced here prior to 2021 really cleaned out a lot of our peers and competitors. The competitive landscape is much less populated today than it was maybe 6-7 years ago. So we're in a very, very good position at the moment. And of course, our fleet, it's best in class for sure. And of course, we hold this first mover advantage on the natural gas power systems. Of course, I mentioned before, we're trading well under our breakup value. Our net equity value is about 75 cents a share. Of course, I mentioned our management and directors hold well more than 40%. So we've committed to enterprise in the long term, and we see ourselves in a very, very, very good position going forward.
Yeah, 100%. We are on the same page. As I said earlier in this presentation, oil prices are higher than their 5-year average. CapEx spending is expected to be higher than their 5-year average this year, but the valuation multiples in the sector are at least 20% or 25% lower than the 5-year average. So valuations in this sector doesn't make sense to us, which is why we feel we are bullish on the sector. And in terms of enterprise specifically, why enterprise is on our top picks list is its valuation. As Des mentioned earlier, the enterprise value of the company is about $34 million, but the company has over $40 million of equipment in inventory. So if you just you can think of it this way: somebody can acquire the company, sell the equipment for $40 million, and make immediately $6 million in cash. So these kind of valuations are unheard of in capital markets, which is why we are bullish on the story and the sector. So, but thank you so much, Des, for doing this. It gave us a clear idea of what you're up to or what your portfolio is, and also your plans for this year. let's open the call to a Q&A. Listeners, if you have any questions, please feel free to type in, or you can click on the raise hand option and I can unmute you. So while I collect the questions, Des, maybe I thought let's take this opportunity, if I may, to pick your brain on what's going on in the sector now. You are based in Alberta. You have your ears to the ground. We see on paper or on the internet now that CAPEX budgets have been increasing. A lot of majors have announced significant increase in their CAPEX budgets. But what are you seeing when you talk to your clients, especially due to the uncertainties going on in this environment where, you know, higher interest rates technically should slow down things? But what's the market sentiment with your clients and prospects?
Well, you know, the few main drivers, certainly with our clients, you know, the upcoming Shell's project, the LNG Canada, that you know is. I saw a headline that they're about 85% constructed. That is something that much of the natural gas production is well behind to fill up that pipe at the time they're expecting to start shipping LNG. So there is a bit of a rush on the producer side to get their production and their reserves developed. So we're seeing that. You know, one of the things that's happening here, I mean, you mentioned high interest rates and what have you. Pretty much all of our producing clients, if anybody's really paying attention, they're doing a tremendous job of buying down their debt and, of course, returning capital to shareholders by way of dividend as well as normal course issuer bid. So these balance sheets are really coming to a spot where, you know, debt levels are dropping dramatically. I mean, our clients are doing terrific right now. Their cash flows and their ability to return capital back to their shareholders is terrific. I mean, that's something I'm sure you're touting as well, Sid. Hey.
Absolutely.
Yeah.
Also, I want to touch on one thing. Is when we initially started looking at enterprise, you know, enterprise falls under the category oil field services company. And immediately when you talk about oil field services, you think of the big names, Schlumberger and all those companies. But we have to be very, you have to make it clear that those large companies are involved in drilling and providing drilling equipment, while enterprise and smaller companies are involved in ancillary services, such as the ones, you know, Des mentioned. But that said, you know, even in the ancillary space, it's highly competitive, small and large companies. Now, Des, have been working with large or majors such as Suncor, Chevron, you know, you name it, most of the majors you have been working with them for many years. How do you build out a repeat business? How do you generate recurring cash flows from these guys?
Well, I mean, you know, let's face it, they need the site infrastructure equipment that we have. We've been an absolute mainstay in keeping the equipment new, in very good operational condition. It always looks good. We're constantly building purpose-made equipment, usually in combination forms that's specific to the client needs. So, you know, we work with the client. We're always providing high quality equipment. So we've earned our ability to be there. And even during that 7-year downturn, yes, activity levels decreased, but we still maintained activity with those clients long term. And of course, we're benefiting today with that position because, you know, as I said, many of our competitors and some of our peers didn't make it through that downturn. And what that allows us to do today is with a much reduced competitive landscape, you know, just our positioning is very good. Like I said, because of the shortage of equipment and of course manpower and what have you, prices have been increasing from the services side. I mean, it's really led by the drillers and the frackers. As you can appreciate, There's demand for the equipment, and I'd hate to be a driller and a fracker today, because if you wanted to put another spread together, you'd be hiring 20 and 30 people at a time. We don't have to do that. You know, we're being in the rental side of things. What I like about our business is it's very employee. It's not that intensive like you'd see with drillers or frackers. So our locations that you saw on the map, you know, when we need to get some more manpower, you know, we're looking for 1 or 2 people per location at a time, not 20 and 30. I'd hate to need 30 people in one location. It's a tough.
So how do we visualize your business? Once you get an order or a contract, you move your equipment to the site. Correct. And then you're hands off. Do you have any?
No, we're not hands off. Our field techs are on call and visiting the sites in either regularity or when there's calls. So we maintain the equipment's operational status while it's on site. That's, you know, why we have locations where we like to be no more than about 2.5 hour drive from some of these very remote locations, as you can appreciate. So, you know, we do have field techs. The reason why our margins, and I haven't talked about this yet, but if the listeners have gone back to, let's say, Q3 of 2021 and go forward quarterly, you'll see that not only our revenues are increasing comparatively to the previous year, 20-30%, but our margins are starting to increase. And that's a number of things. We're a finely tuned instrument, you know, operationally, but operating the natural gas systems, they're far more reliable. There's less, you know, moving parts and what have you. So our field techs, which are our cost, when they have to go out and maintain equipment or swap something out or what have you, that's cost for us to go out to site. We're doing a lot less site visits because the reliability of these packages are markedly better. So, you know, if you look at our margins on Q1, you know, over 50, I think 51% gross margins, 44% EBITDAs. Man, those are numbers that our peers and competitors that are public, they're not repeating those numbers. They're almost like software kind of margins. So we're in a good spot. You know, we're probably going to see our activity levels and the Canadian energy sector continue growing the way it is. So I expect that we'll have higher revenues, but what we are promising as management is we want to hang on to these margins. And of course, I think we will get recognition in the market. I don't think you can repeat the numbers that we're doing and not get recognition at some point. So I think we will.
So for listeners, just to draw some analogies here. Now, company has about $40 million in equipment, generating about $30 to $40 million in revenue every year. So it's pretty much the ROI is almost, you know, if you look at just revenue, it's almost 75% of the equipment money or capital you are generating revenue every year, every single year. So you can see how attractive the economics is. Does that make sense, Des? How we look at things?
Yes, absolutely. Yeah.
Okay. Now I have a question related to competition here. Who are your major competitors and what is your competitive advantage?
Well, I mean, I think I mentioned our competitive advantage is obviously our power systems are very much in demand. Our adoption rate for the large clients that are our existing clients has been high. We've also been attracting new names to us, so we're advancing our market share because of our equipment offering. Being that we're the only ones providing this diesel to natural gas switch, you know, we're getting a pretty good adoption. So not only is the market better that we're existing in, we're getting a better market share every quarter because of our equipment offerings.
Okay.
Nobody's offering these. You know, naming. I'm not sure anybody will, you know some of the names. There's very.
But
few
are they small, medium size, or small companies? I don't.
They tend to be small regional players. We're one of the only few that operate in these multiple locations spanning, you know, a couple, 3 provinces type thing.
Is it fair to say that you're one of the very few publicly traded companies offering this niche services?
Yeah, there's another one out there. They just do different things than we do. I think that would be Zedcor. Would
Okay,
be but they're fairly focused on their light tower with security cameras on it. And it's kind of a focus on one sort of product line, and they're doing a good job getting those things out there. If you go down the Trans Mountain Pipeline into BC and what have you, you'll see some of their product out, because let's face it, some of these big pipeline projects in today's world, there's a lot of sabotage going on and people that are against pipelines and whatever. So these little security systems
got it.
are they're doing well for them. But so that would be maybe a comparative situation. We just don't do the same thing.
Okay, I have a question here. What's your expected ROI, return on equity, for this year? Maybe I can answer that because we provide projections for enterprise in our reports. So we're expecting close to $4 million in net profit in the next year. That's an average for the next 2 years. And then the invested capital equity is around $35 to $40 million. You're looking at a 10-12% return on equity in the coming year or so. And in the people who are familiar with real estate, you can see that it's a similar business where it's an asset and then you rent out the real estate. The cap rates in real estate is anywhere from 3 to 5%. So the oil field service sector is generating 10 to 15% versus 3 to 5% for real estate. Now, in your current existing fleet inventory, I mean the fleet of equipment, what's the maximum revenue you can generate? In other words, do you have to spend more money on equipment in the coming years? Do you have any major CapEx for yourself? Do you have to raise money?
Well, we haven't raised capital in years. Obviously we're not interested in diluting the share base at these kind of price levels. We've had the cash flow to support our CapEx. There's no doubt we started retooling our power fleet to natural gas, 3.5, almost 4 years ago now. So it's been all out of cash flow. We've also been able to support our NCIB share purchases through cash flow. So, and of course, cash flow is getting better every year. So we see no reason to go to the market to support our needs for CAPEX. I mean, CAPEX at the moment, it's really as there's customer demand for more natural gas power systems, that really is the majority of our CAPEX going forward. Obviously, there's things, after 5, 6, and 7 years, some equipment we like to sell off and replace, and so there's a replacement CAPEX there as well. But we don't expect to be out there raising capital for our CAPEX needs, certainly at the moment. There might be some opportunities for M&A, and we'll take those as they come. I mean, we've been historically, if you look across the 18 years that we've been around, I think we've done 9 or 10 acquisitions. So if there's something quality out there, something that we can make 1 + 1 = 3, we'll make a move on it.
Yeah. You also have your balance sheet holds debt. Where's that debt coming from? Is that from an institutional lender or individuals?
No, it's an asset-backed facility by Wagar. Wagar is an affiliated lending group from. You're familiar with 9 Point? Some people know Eric Nuttall. He's kind of Canada's biggest oil and gas fund manager. So 9 Point has raised basically lending capital for industry, and it's operated by Wagar. So our facility is 30 million, and I think we're drawn down maybe in around the 10.5 million range. 10 to 11 million is what the facility is drawn down. Yeah.
Your questions on your gross margin. The question specifically is your gross margins in the last 4 quarters was pretty fluctuating between 46 and 30%. Can you explain why? I'll attempt first before I give to Des, but this business is pretty seasonal. Q1 and Q4 tend to be highly active. So most of the companies' revenue come in those quarters. So that's why we can expect quarterly fluctuations in gross margins. But Des, do you want to add anything to that?
Well, no, you hit it. There's no doubt. I mean, if we were to look at the 4 quarters of the calendar, you know, Q4 and Q1, which is the cold season, more activity happens in the cold season. Let me explain. So in these remote areas, much of these remote areas are wet, you know, muskeg, or they're just wet areas out in the frontier. And it's easier to get heavy equipment into those locations when it's frozen. So activity levels from about October through to the end of March are the strongest. Okay. The next best quarter would be Q3, the dry summer quarters that we're in now. The sort of least activity is Q2, which is what we call spring breakup. Basically, when those wet areas are thawing, and of course road bans happen, so heavy equipment is very very difficult to move around in that breakup quarter while things are thawing. So Q2 that we'll release here in you know, a few weeks, you know, is the lowest activity quarter because of the thawing of the ground.
Got it. But if you look at comparable quarters, so I'm just looking at our latest Q1 2023 report. You can see that gross margins have increased every year in the past 3 years, up from 33% in Q1 2021 to 46% in Q1 2022 and 51% in Q1 2023, clearly indicating that you have been increasing prices. And as you mentioned earlier, since you don't have too many employees as direct cost, your COGS has not increased with your revenue. So going back to the point, so you have been raising prices pretty consistently. Does that also show that competition has not been that intense?
Well, you know, I guess you'd have to come to that conclusion that it's not only a competition. There because of the lack of number of players that are competing for the business, a lot of that equipment, when those companies went out of business, that equipment was sold and was scattered, you know, all over North America and worldwide. I mean, these Ritchie Brothers auctions that are held in Edmonton, you know, half the equipment goes off the continent, so it really gets scattered a lot. So once it leaves Western Canada, it's gone, right? So we're at a point now where we have activity levels going up, and of course we need the equipment. And you know, I must say that the drillers and the frackers are the first ones to increase their prices. So, you know, we follow that, you know, when there's opportunities to increase prices, you know, we've taken that opportunity. Let's face it, some of our costs have gone up too, Sid. I mean, you know, to keep employees and what have you, you know, there's other opportunities all over the place. So, you know, we've had to, you know, improve our compensation to employees. You know, the employees that we had when times were bad, you know, those are the high quality people that, you know, if you had to make cuts and what have you, you're always going to make cuts with, you know, the people that are less efficient for you. So we're positioned with a very, very highly efficient and really desirable workforce at the moment. So we like where we're at. They deserved some raises along the way because they worked really hard. I mean, you know, this last Q1 that you're reading the numbers off of, I mean, it was an old-fashioned winter. It was cold out there. These guys are working in the elements, and they, you know, we did terrific business, and you know, they require some pickup in compensation as well. So some of our costs have gone up higher, but as you can see, as you read out those last Q1 numbers over the last few years, you still see amidst those expenses rising a little bit, we're still able to keep increasing the margin. So yeah. We've had a couple of price increases per year over the last couple of years. So we're just trying to get back to where we kind of were in 2014. And, you know, here we are.
Got it. Yeah, just to add some points to numbers to what Des has said. In 2022, revenue increased 44% and G&A expenses increased 34%. So staff costs are increasing, but revenue has been outpacing, revenue growth has been outpacing G&A. There are a bunch of questions on revenue forecast, EBITDA forecast. So for that, I would highly encourage you to check our report on enterprise, not just our Q1 report. You can see going back to our initiating report, which we did 2 years ago. So again, research frc.com and search for enterprise group, and you can see all of our reports with our valuation on the company. Just one more question. I think we're now at 40 minutes plus now, so might be good time to wrap things up. But there's a question on, are most of your revenue coming in from Canada or US? And do you have plans to grow internationally?
No, we're 100% Canadian operating at the moment. Yeah, there could be opportunities in the US. To be honest with you, at the moment, we've got a tremendous amount of runway here in Canada that we feel we can grow into. I think we can, with the offerings that we have. I think our ability to get over 100 million sometime in the future is well intact. You know, distracting ourselves with the American market, I don't think would be appropriate. So we're going to stay here where we're well known in the Canadian market and keep increasing our market share here.
Fantastic. I don't see any more questions, Des, but thank you so much for taking your time, and also to everyone on the call for taking time today. A recording will be uploaded on a YouTube channel shortly. Please ensure you subscribe to our channel and also sign up to be a member of our platform, researchfrc.com. You'll get alerts when we publish new reports, and of course, you'll be able to see our list of topics. Des, any final thoughts?
Well, I guess, you know, I can't stress enough that, you know, if these financials and these results that we're putting out, they will have to get recognized at some point. They are that good, and you know, the producers have had their time in the sun. You know, some of our clients, like the Tourmalines of the world, you know, 3 years ago were, you know, under $10, and they're, you know, $65. Same thing with Canadian Natural Resources, you know, $11, $12 at the same time. Now they're well into the 70s. So they've got their recognition. Some of us in the service sector lags, and I think our time for recognition is going forward from here.
Very good. And Q2 results are coming out early August or later this month?
Yeah. We have our audit meetings with the directors around the you know, 9th, 10th of the month, so a few days after that.
So we'll be doing an update shortly after that. So please check out our platform and also follow Enterprise on their website, Yahoo Finance, CEDAR, everything. But yeah, thank you so much, Des. Appreciate it, and have a good day. And thanks for watching, everyone.
Thank you, everyone.